Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors second quarter 2015 performance updates. I will be providing a brief second quarter performance overview of all of the iSector models and conclude with our near-term economic perspective on the market. This call should last about 15 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of the presentation to all webinar attendees immediately after this call. The Post-MPT allocations underperformed their benchmarks in the quarter. Post-MPT growth lagged its Standard & Poor's 500 benchmark due to real estate holdings that are no longer in the portfolio and energy stocks. Post-MPT moderate trailed its 60% stocks, 40% bonds benchmark due to an allocation to long U.S. Treasury bonds and energy stocks. Both strategies benefited from healthcare stock holdings. As the chart on slide 3 indicates, Post-MPT growth continues to experience a shift in its allocations. The strategy currently incorporates the lowest amount of leverage since October 2013, after tracking close to its 33% maximum for over a year. The model is still moderately positive and indicates that U.S. equities is still an attractive class. You will also note that the allocations have shifted from real estate into bonds. In fact, the allocation's investment in U.S. Treasury bonds stand at its highest level since January 2013. Since the strategy's benchmark is the Standard & Poor's 500, the model is indicating the Treasury bonds could outperform equities, especially if stocks turn lower. Additionally, both strategies continue to be overweighted in financials and healthcare. iSectors Post-MPT growth continues to outpace other global allocation strategies. We are pleased that the allocation is ranked second among 32 global allocation ETF strategies for 10-year performance and second out of 70 global allocation strategies for 5-year performance in the Morningstar ETF strategies database. We expect Post-MPT growth to continue its reputation as one of the premier allocation strategies utilized by investment advisors. As you will see for a number of our strategies, energy and metals holdings negatively impacted the endowment and liquid alternative strategies during the quarter. Both endowment and liquid alternatives could not keep up with its benchmarks. Slowing global economic growth has hurt demand for both energy and metals. Fortunately, as you can see in a chart on slide 4, commodities in general performed well, with the Rogers Commodity Fund rising 8% from its March low to the end of the quarter. Both allocations are broadly diversified and should recover when the commodity markets stabilize. In the meantime, it should be noted that liquid alternatives have outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, and availability to all clients, not just accredited ones, liquid alternatives should be considered for diversification as equity returns ease. A large allocation to U.S. dividend funds led a domestic equity strategy to underperform the global equity allocation. Non-U.S. developed market stocks also hurt global equity. On the other hand, the global fixed income allocation outperformed due to international high-yield corporate weightings. International government bonds, especially in Europe, underperformed other fixed income sectors. Although U.S. equities continue to lag the international markets in the short run, the iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most ETF strategies. In fact, the domestic equity allocation is number 12 out of 445 ETF strategies in the Morningstar database for 5 years performance. The downdraft in energy and metals continue to strongly affect our inflation protection and precious metals allocations. Thus, as you see in the chart on slide 6 for Kane Anderson Energy Development Company, a fund of energy master limited partnerships, April's performance plateau preceded May and June's decline. Inflation protection's drop was tempered by its broad commodities exposure. Precious metals continued its decline on the backs of falling platinum and palladium prices. Even with the recent negative performance, iSectors inflation protection allocations performance has met consumer price inflation increases over the past 5 years. Given a downshift in likely equity returns over the next few years, it may be wise to include inflation protection as a diversifying portfolio in clients' accounts. As the chart on slide 7 indicates, capital preservation has earned over 2.75% on an annualized basis over the past 5 years. The yield is attractive with a short duration while maintaining investment-grade quality on average. Capital preservation was up slightly during the quarter. As with the global fixed income allocation, capital preservation was positively influenced by international high-yield holdings in the quarter. Finally, the tactical global balanced allocation underperformed its 60% stocks, 40% bond benchmark in the second quarter. U.S. small cap stocks continue to lead the strategy's performance. But the gains were reduced by mistimings in emerging markets and, as indicated on the chart on slide 8, the real estate sector. Currently, the allocation is over 80% allocated to cash equivalents with small holdings in U.S. large and small cap stocks. I have included some charts on slide 9 that illustrate some of the numbers behind our economic and market forecasts. As the chart on the right indicates, the U.S. economy is reaching full employment. Initial unemployment claims have sustained readings under 300,000 per week. The chart on the upper left, indicates that U.S. money supply growth has accelerated in the past 5 years. Finally, the lower left chart presents 1 month to 1 year S&P returns after gold prices hit 4-year lows as it did on July 17. Historically, stocks have had positive movement from these points, especially in the 6 and 12-month time frames. These and other factors indicate that earnings growth will be steady over the coming year, and we should be bullish on U.S. equities. Unfortunately, the international situation is not so rosy. This can be seen in the top left graph. Although one should be suspicious of the data released by the Chinese, even their official data indicate that money supply growth is dropping. Although money growth in Europe is fine, Japan's money growth is flat to declining. Thus, decelerating global economic growth is a potential drag on U.S. economic prospects, and we feel it will cause the Federal Reserve to slowly raise the Fed fund rates. Although we agree that the Fed is likely to initiate interest rate hikes this year, we think the market has overestimated the number of increases next year. Instead of 3 hikes in 2016, we believe there'll be 1 or 2. Thus, we are positive on the U.S. Treasury market. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them into the chat box in the lower right-hand corner of your screen. We have received our first question, and it is, are the models positioned well for the rising interest rate environment? There's two parts to this question. One, are we in a rising interest rate environment? Clearly, interest rates went up in the second quarter, and thus they rose higher. But so far this month, and we think into the second half of the year, interest rates are going to be steady to declining. And so we are not concerned about the near-term prospect. But when it comes to the long term, we do believe that there's a secular move to interest rates rising. And because of that, we have been very diligent to make sure that the risks we're taking in the models will not be hurt by rising interest rates. In many cases, we are further diversifying the portfolio into sectors that should perform relatively well in even a rising interest rate environment, and that the current yield are so attractive that given the slow pace that we expect interest rates to rise, we will do well. The second question is, what is the dividend yield on the domestic equity? My understanding on the dividend side of the domestic equity, and my understanding that it's something close to 1.4%. I'll double check that and see if that's correct. I know it's over 2% on the global equity portfolio. Are there any other questions? My trusty assistant has indicated to me that it is a little over 2% on the domestic equity portfolio. The global equity portfolio is more like 2.4, 2.5%. Seeing no other questions, I'd like to conclude by thanking you for attending our webinar this afternoon. If there's anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 800-869-5184. Again, thank you, and hope you all have a wonderful summer.